Good morning, everybody. I hope you're doing well. And what another interesting few days and weeks in this crazy market. Welcome to the Hurley Investments Trade Findings and Adjustments of May 14th. I'm Keith Bybee. To start out, Kevin had mentioned to me that our SPY bear put, can be taken off for 9% gain if you'd put that on, that he had suggested from Tuesday night and to this point. And that is a good thing to take a look at and book a profit on if you would like. So it would have been for what, a Wednesday morning. So pretty cool there. Just wanted to follow up a little bit with some things that I've talked about before. We talked about a target covered call, and I'm not sure if there was a chance to ever get filled at this price for credit. Let's look at target. I had Facebook up, but so that was what, May 7th, and the low was 113. So you would have had to be a little more creative and go up into a strike price or two to try and get some decent credit and an upside there. So assuming, well, why don't I just ask you, is anyone that tried to do that, a target covered call that I had suggested by chance? Well, hopefully if you did and you did the May monthly, you would have gotten some decent credit, even if you had paid what, 113 and done a 114 covered call or at the money somewhere. You'd have gotten pretty similar pricing, pretty close around May 7th or so. So you'd be at this point booking a decent profit soon here on Friday when those expire worthless, and you'd been called away at a profit from shares being capped up there. Pretty amazing to see it kind of scream up past that 110, 112-ish, I guess more like 113 level, and just head up a good $6, $7 more than that. So that's kind of cool. And of course, you look back at that and think, well, man, if I'd have just been patient and just let it run, or if I'd have just waited a little bit and capped it higher, or whatever the case is. But it's as we always say, you never go broke taking a profit. And I don't know, there might be some better, depending on what your situation is. My situation was kind of what it was, and I had been in a target covered call from the beginning of the year that I had to run through, all this period here with, and I had leap calls as well, so I had that combination, and I'll go over more of that in a second. But my situation was that I was ready to get out of it and look for other opportunities and go at it that way. So hopefully, if you've done that, you're looking at a nice little return there. Facebook was a little different. Anyone do the Facebook leaps I had suggested? So January 22, 250 strike calls. I can't remember what those cost off the top of my head, but I'd suggested to leg into a contract and see if it had come back to 200-day moving average to leg in with another contract, and at that point still have some room if for some reason Facebook continued to head down, you could easily dollar cost average with cash you have set aside. So that was that. But in all honesty, if you had put that on, what, the 7th, yeah, you could have got out for a profit, maybe not huge, and you'd be a little down right now. But I would still just be patient, obviously, with having all that time out to January 22 and the ability to dollar cost average there. I would, I would stick with that if you're doing it, or if you didn't do it, you still have time and look at seeing if it holds a $200 support level, or if it heads down to test this 191. Let me put the pivot points on here that we like to use. And yeah, so I mean, there's really nothing, kind of say 200 just because it's an even price, and it just seems through quite a period of time that Facebook has kind of struggled between the two, getting over or staying above 200 for any real period of time. It did get as high as 223 back in January. So that's that. I'm gonna go ahead and erase this because it was on my last one. Again, I think that was the 7th, May 7th. So if you want to look at those, you can always go back there. And I have here a screenshot of the history of my wife telling me the kids are upstairs so that they're not making too much noise. Thanks, honey. All right, so I've got the screenshot of all the history of basically everything that's happened with my target. And if you remember way back here on the 6th of February, I think even back then I had sent this out as a covered call deal to look at. And obviously having to ride through what has happened the last 2 months, 3 months, quarter. So bought 500 shares at 115. It cost get my calculator out, 57,685. So you're looking at that and where it's trading now, and where I'm capped at is 110 for $2.71. And so really about 1271. 112.71 is where I'm capped at there. But if you notice, there's a big 500 here, and you notice back on the 3rd of April, I've got another 100 here of shares to make it 600, and a total of 6 covered calls, 110. So my cost basis, just if we're looking at share wise, I paid 115.37 for 57,685 plus over here to 100 more shares at 9,123. Down at $91.23 a share. Divide that, that's 66,808. Divided by 600. Equals 134, 111.34. And I'm going to be called away at 110 with $271 of credit. So $1.37 roughly of profit, right? So go through here and look at, we had booked profit on, so that's just looking obviously just at the, shares, if nothing else, The cool thing was after I had started this on the 6th for a covered call strategy that had worked pretty good through the end of last year, we got into the situation we did and we had to add protection. So, but we also got to book profit on more short calls. So we can kind of add all that up. And then once I had another 100 shares, had protected with a few different bear puts that added cost back in, that whole thing. So let's look at that. So let's go with the puts just for now. Put right here, 5. You can see I bought 10 here. It must have been by mistake because then I sold to close 5, which means I have 5 left over. kind of funny. Key view dummy, don't buy 10 just because the order automatically puts 10 in for you. All right, so we had 5. That cost about $25.62. And that was on a April 3rd 113 put. So if we go up and find our April 3rd 113 put, what cost us about $5.13 is now worth $21.40, or about $10,697. So subtract that out for our profit. Around 8,134. Oops. So that was able to give us another 100 shares, which cost 9,123. Now, obviously the puts didn't pay for all of that, but we did have short calls to cover it for a full collar trade at this point, and I'll add that back in. So let's see. So we bought it. 100 new shares here at 91.23. Kind of already have the cost basis there. What's great though is the fact that 8,000 plus another 1,030, and you know, all the other short calls paid for all of the new shares, 100 new shares. And that was really the key, not just lowering the cost basis, but now you have 100 new shares at a lower cost basis of 91.23 that helped out significantly to get back to break even, right? So that was pretty awesome. Let me add in the short calls. Bought open, that's long call, sold short 118 for $1, so 537 of credit, which less volatility back then, didn't get as much credit. And then where that closed, that expired worthless, so we kept all of that profit. And then somewhere in here we've got another sold short 115 call for $1.50, so we'll add 747. That gets us to about 1284. And then 115 call. See where that closed off. Closed it, bought to cover right before expiring for about $5. So we'll minus out $5 just to be square. And then we have the 110 call up here for 271. We kind of already factored that in, so I'll leave that where it is. So another 2,079. For a total of 9413. So if you're adding up and you're kind of seeing this, you're seeing that I'm going to be called away here Friday for really not a ton of profit on my shares. I do need to add in what, a dividend of 330. Okay, let's add the dividend. Why not? Which brings us to 9743. But again, I was trying to get out for a break even to have a different opportunity. Yeah, I could have just kind of let it go and been more patient with it and been more long term. But here's the reason why I didn't. And it goes to these leap long calls. Otherwise, I might have just kept it. But to open, I'm going to go down here. Oops. So 3, I know this is kind of small. Let me zoom in so it's a little better for you. So 3 target 135 calls that cost 450, or a real cost of 1,351. Then that was on January 24th. And really that was rolling profit from the covered call that we had done end of last year for a Christmas rally on target that went well. And, you know, just in case it kept going up type of thing, we had the leaps to roll that into and have something there. So that was the reason behind it. So that was January 24th. Then bought to open 6 more. Same leap contracts, 135, January 21, 135s on March 2nd. So let's just for fun. March 2. So that day it had bounced on the 200 day. So you can kind of see the reasoning there. After having fallen here, having a huge bounce February 28th, after that weekend, and from falling from back here. Well, I guess for January 24th, this is when we would have had the original ones. January 27th, target. Get my 135 calls. So bought 3, cost basis of 1,450 or 1,351. And to make it a little easier, I'll just go with the total cost. Rather than per share, because we really just want to know how much we made. And we bought 6 more. That we paid $35 less for $450 for the first one set and $345 to triple down. That's $2,073. So if you're adding that up, that's $34.24. And then thank you for bearing with me, just kind of going through it. So 6 more with a total of 9, right? And then I think we just held those until, let me see if I bought any more. 135, 135. So yes, yesterday, 513, sold those off. So total of 34.24. And then sold them all. I don't know why it's splitting them into 2 different ones, probably because they had 2 different cost bases, but sold them all together for $6,894 and $1,378. $8,272. Don't need to capitalize yesterday. For a profit of $4,800. So that's why. A little better than the $1.37 or about $800 of profit through kind of a crazy swinging period, right? In a retail store stock that, let's be honest, could be awesome with how many online sales they've had, or the fact that nobody's going into the store could really drag on it as well and kind of offset that positive. So pretty cool. What do you guys think? Did I cash out too early? Kind of cashed out right at the top for my calls, but as far as my shares, would have been cool. But you know what? Having all of those all together, it changes your perspective, meaning shares and leaps on what you're comfortable with on profit wise and your risk. Target is a good one that has, a good dividend. So I was playing that dividend and kind of got stuck with it and turned it into a full collar trade, and I'm getting out at a profit, and I'm cool with that. So I like it. What do you guys think? Interesting, good job, meh, could have done better, Keeve, good enough, now go find something and put it into something better, or look to pick it up again if they sell off after their earnings. I think the latter there is how I feel right now. I think that's it for me. Not seeing any other questions come through or thoughts, but that's it for me today. I kind of like it. That's what I'm comfortable with, and I'm happy that it went as well as it did. And another good reason why it's important to understand the collar trade, especially for a covered call strategy where you might have to get stuck with something for a little while. But on the other hand, light at the end of the tunnel. Some things, we've been in simply haven't come back yet, but the process of adding the shares as they've come down is what works and will give us more profit into the future. So, no other questions coming in, guys. I really appreciate you joining me. Thank you very much, and look forward to being with you Monday night, listening in on what Kevin has to say for the commentary there. So thanks again, and we'll see you then. Bye.